For the last 100 years, financial crashes haven't been random. They didn't start with panic, they didn't start with headlines, and they didn't start with people screaming, "Sell." They started quietly. So quietly that by the time the public noticed, the damage was already locked in. Because the real danger isn't the crash itself. It's the pattern that comes before it. A pattern so consistent it appeared before 1929, 1987, 2000, and 2008. The same roadmap, the same signals, every time. And right now, that pattern is active again. This isn't about predicting tomorrow. It's about understanding how systems actually break. If you go back and study every major financial collapse of the last century, one thing becomes very clear. Markets don't collapse when people are scared. They collapse when people feel safe. In 1929, newspapers were celebrating a new era of prosperity. In 1987, computers were supposed to make markets safer. In 2000, the internet was said to rewrite the rules of economics. In 2008, housing was considered the most stable asset on Earth. Different decades, different technologies, same belief that this time is different. And that belief is where the pattern always begins. Because before any crash, there's always a long period where risk stops feeling like risk. Debt feels normal, leverage feels efficient, and warning signs are dismissed as outdated thinking. This is the phase where markets don't look dangerous at all. They look healthy. Indexes rise steadily, volatility stays low, corrections are shallow and short-lived. Every dip gets bought, every fear gets absorbed, every problem gets delayed. And that's exactly the issue. Because stability in financial systems is often artificial. It's created by policy decisions, cheap credit, and incentives that reward short-term growth over long-term resilience. This is where the first stage of the pattern quietly forms. Not through panic, but through excess comfort. Credit expands faster than the real economy. Debt grows faster than income. Assets rise faster than productivity. At first, this looks positive. Easy money fuels investment. Rising prices create confidence. Confidence attracts more participation. But underneath the surface, the system becomes increasingly fragile. Because debt doesn't just amplify gains, it amplifies sensitivity. A system built on leverage doesn't need a large shock to break. It only needs a small one. This is why crashes are rarely caused by the event everyone remembers. The event is just the trigger. The damage is already baked in long before it happens. Think of it like pressure building inside a sealed container. From the outside, nothing looks wrong. No cracks, no leaks, no noise. Until suddenly, it ruptures. And when it does, people ask the wrong question. They ask, what caused the crash? But the better question is, how long was the system already unstable? Because markets don't fail because of bad news. They fail because they were no longer able to absorb stress. This is why focusing on headlines misses the point. Headlines only describe the spark. They never explain the structure that allowed the fire to spread. And this is where most people lose. They react to symptoms instead of understanding mechanics. They panic when prices fall, even though the real danger passed months or years earlier during the period of unchecked expansion. This is why understanding patterns matters more than predicting dates. The pattern doesn't tell you when something will break. It tells you how vulnerable the system already is. And right now, we are not in a panic phase. We are in a confidence phase, which is exactly where every major crash has begun. Every financial collapse starts the same way. Not with fear, not with speculation, not with a bubble popping. It starts with credit. This is the part of the cycle that feels the least dramatic, and that's exactly why it's so dangerous. Before every major crash in modern history, debt grows faster than the economy that supports it. This happened before 1929. It happened before 1987. It happened before 2000. It happened before 2008. And it's happening again now. Credit is not inherently bad. In a healthy system, credit helps businesses expand, families buy homes, and economies grow. But when credit expands without restraint, when borrowing becomes easier than earning, the system begins to distort. People don't borrow to create value anymore. They borrow to chase prices. Companies stop investing in productivity and start leveraging their balance sheets. Consumers stop saving and start financing lifestyles. Governments stop budgeting and start rolling debt forward. At first, it feels like progress. Growth accelerates. Markets rise. Unemployment stays low. But this growth is fragile because it's not built on income or productivity. It's built on leverage. And leverage creates one critical vulnerability: sensitivity to change. When debt levels are manageable, the system can absorb shocks. Interest rates can rise a little. Growth can slow a little. But when debt becomes excessive, even small changes become destabilizing. A small rate hike suddenly increases costs everywhere. A minor slowdown breaks cash flow. A tiny default cascades through balance sheets. This is why credit expansions don't end gracefully. They end abruptly. And here's the part most people miss. Crashes don't happen because people borrow too much. They happen because borrowing becomes normalized. When debt stops feeling risky, the system has already crossed the danger line. Right now, total debt as a percentage of economic output is higher than it was before the Great Depression, higher than it was before the 2008 financial crisis, higher than at any point in recorded history. Yet markets are calm. Why? Because credit expansion masks stress. As long as new borrowing can cover old obligations, everything looks fine. Defaults stay low, asset prices stay elevated, but this creates a dependency. The system no longer runs on productivity. It runs on continuous credit growth, and that's a problem because credit cannot expand infinitely. At some point, borrowers reach limits, rates rise, confidence slows, and when credit growth decelerates, not reverses, just slows, the system begins to wobble. This is the phase we're entering now. Not collapse, not panic, but strain. You see it in rising refinancing costs, in corporate balance sheets quietly deteriorating, in governments rolling larger deficits just to maintain stability. This is not the crash phase, this is the setup phase. And it always comes before concentration, liquidity stress, and ultimately the trigger. After a credit explosion peaks, the system doesn't collapse immediately. Instead, it narrows. This is the stage where markets look healthy on the surface, even strong, but the strength is an illusion, because growth stops being broad and starts becoming concentrated. This is what I call the concentration trap. Here's how it works. When credit has expanded for too long, risk doesn't disappear, it compresses. Capital stops spreading evenly across the economy, begins flowing into fewer and fewer places that feel safe. Big companies, familiar names, assets that can't fail. At first, this feels reassuring. Indexes keep rising, portfolios look fine, headlines talk about resilience, but underneath, something dangerous is happening. The system is becoming dependent on a very small number of assets to carry the entire market. Historically, this happens every single time. In 1929, a handful of industrial stocks carried the market. In 2000, it was large tech names. In 2008, it was housing-linked financials. Today, the pattern is even clearer. A tiny group of mega-cap companies now represent an unprecedented share of total market value. Indexes are no longer diversified. They are leveraged bets on concentration. And here's the key insight. Crashes don't happen because prices are high. They happen because risk is unevenly distributed. When too much capital is stacked in too few places, the system loses redundancy. There is no backup. If one pillar cracks, the structure doesn't bend, it snaps. This is why concentration is more dangerous than speculation. Speculation is visible, concentration is hidden. Most people think they're diversified because they own an index. But in reality, they're exposed to the same few balance sheets, the same revenue streams, the same macro risks. And concentration doesn't just happen in stocks. It happens in credit markets, real estate, technology infrastructure, supply chains. The entire system begins leaning on fewer supports. Why does this happen? Because after long credit expansion, safety becomes an illusion. Money stops chasing opportunity. It starts hiding in size. Big companies feel safer. Liquid assets feel safer. Crowded trades feel safer. Until suddenly, they aren't. This is the most dangerous phase psychologically because nothing looks broken yet. Markets are still near highs. Volatility feels controlled. People are confident. But resilience is gone. At this stage, the system doesn't need a large shock. It needs a small one in the wrong place. And that's when the next phase begins. Because while the public is being pulled deeper into concentrated exposure, something else is happening quietly in the background. The people who understand this pattern, the institutions, insiders, and long-term capital, start preparing for what comes next. Not loudly, not dramatically, silently. By the time a market reaches extreme concentration, the danger is no longer theoretical. The system is fragile. But here's the part most people completely miss. Markets do not collapse when everyone is panicking. They collapse when confidence is high, and liquidity is quietly leaving. This is the stage I call the smart money exit. And it never looks dramatic. There are no flashing red alerts, no emergency speeches, no headlines screaming sell. In fact, public messaging usually becomes more optimistic. Strong economy, soft landing, resilient consumer, AI-driven productivity, new era. But behind those words, behavior changes. Institutional investors don't exit markets by hitting a big red sell button. That would crash prices and hurt their own positions. They exit slowly, quietly, strategically. They reduce exposure over months. They rotate into cash, short-term instruments, and hard assets. They hedge. They stop adding risk. And most importantly, they stop providing liquidity. This is the key. Smart money doesn't cause crashes by selling. They cause crashes by not buying anymore. Liquidity is what allows markets to absorb shocks. When it disappears, prices don't fall smoothly. They gap. Historically, this phase always leaves fingerprints. Corporate insiders sell shares at elevated levels. Executives cash out stock options. Buybacks slow. IPO activity dries up. Mergers get delayed. Private equity waits. Meanwhile, public-facing commentary stays bullish. Why? Because institutions sell exposure, not confidence. Confidence keeps prices elevated long enough for them to exit without causing panic. And retail investors? They mistake calm prices for safety. This is why this stage is so dangerous. Nothing looks wrong yet. Indexes are near highs, volatility is low, portfolios look fine. But the depth underneath the market is gone. Think of liquidity like oxygen. As long as it's there, everything functions normally. But you don't feel it disappearing until suddenly it's gone. And when liquidity vanishes, markets don't adjust gradually. They break suddenly. This is why crashes feel so violent. It's not because something massive happened overnight. It's because the support structure was already removed. And here's an uncomfortable truth. By the time the public realizes smart money has exited, the exit is already closed. This is why history keeps repeating. In 1929, insiders sold while the public piled in. In 2000, venture capital exited while retail chased tech. In 2008, banks reduced exposure while mortgage risk was still being praised. Different assets, same behavior. Today, the signals are familiar. Institutional positioning is cautious. Cash levels are elevated. Hedging activity is rising. Insider selling is historically high. Yet public narratives remain confident. This contradiction is not accidental. It is structural. Markets are not democratic. They are hierarchical. Those at the top move first. Those at the bottom react last. And when reaction replaces positioning, the final stage arrives. Because once liquidity is gone, all it takes is a trigger. Not a big one, not a dramatic one. Just something small, in the wrong place, at the wrong time. Here's the mistake almost everyone makes. They believe crashes are caused by big events, a war, a bank failure, a policy announcement, a headline so dramatic that it forces markets down. That's not how crashes actually begin. Crashes are not caused by triggers. Triggers only expose what was already broken. By the time we reach this stage, credit has already expanded too far, risk is already concentrated, smart money has already exited, liquidity has already drained, the system is unstable. All it needs is a spark. And history shows something unsettling. The trigger is almost always small. In 1929, it wasn't the Great Depression itself. It was a relatively minor British fraud case that disrupted confidence. In 2000, it wasn't the end of technology. It was a series of earnings misses and tightening financial conditions. In 2008, it wasn't housing prices falling. It was Lehman Brothers, a single institution that revealed how interconnected everything had become. The trigger never matters by itself. What matters is timing. A fragile system cannot absorb shocks, even small ones. That's why crashes feel sudden. People say it came out of nowhere. But the pattern was there for years. Here's where we are now. We've already seen historic credit expansion, extreme concentration in a handful of assets, quiet institutional de-risking, liquidity tightening under the surface. That means the system is no longer resilient. It's brittle. And brittle systems don't bend, they snap. This is why timing predictions are mostly useless. The question isn't what will cause the crash. The question is what won't? Because once you reach this stage, almost anything can act as the trigger. A geopolitical event, a credit accident, a policy mistake, a corporate failure, a sudden repricing of risk. The spark is unpredictable. The structure is not. And this is where most people misunderstand the warning. This is not about fear. It's not about selling everything. It's not about timing the exact day. It's about awareness. Because those who suffer the most in crashes aren't the ones who were wrong. They're the ones who were unprepared. They believed stability was permanent. They believed liquidity would always be there. They believe markets only go down when something obvious breaks. But markets don't reward belief. They reward positioning. This is why understanding the pattern matters. Not so you can predict tomorrow, but so you don't get blindsided when normal suddenly isn't. Every major crash in modern history followed this roadmap, not because humans are foolish, but because systems behave the same way under stress. And that's the real warning. Not that a crash is guaranteed, but that the conditions which allow crashes are once again in place. If nothing happens, markets drift. If something happens, markets gap. That's the difference. So when you hear, everything is fine, soft landing achieved, this time is different, remember history. The danger isn't panic, it's comfort. And the warning isn't the crash, It's the pattern that comes before it. At AG Currency, we don't predict dates. We don't chase fear. We study structure. Because once you see the pattern, you stop reacting to headlines and start understanding risk. That's how you stay ahead of the cycle instead of getting crushed by it. Thanks for watching.